Hello, everyone. I'm Sarah from Mackoul Risk Solutions. Welcome to our webinar, Explaining the Hard Market. We appreciate you joining us and hope you find today's presentation interesting and informative. In this webinar, we'll cover factors that impact the hard market, what is driving the premium increases, why commercial umbrellas are out of control, and how long you can expect this to last. A few things before we get started. First, if you have any questions during the presentation, please type them into the Q&A box located at either the top or bottom of your screen. We've allocated some time at the end of the presentation to go over questions. Second, a recorded version of this webinar will be sent to all participants within the next few days. Lastly, by attending this live webinar, you'll be entered to win a $50 Amazon gift card. Now, without further ado, I'd like to introduce today's presenters. We have Ed Mackoul, CEO of Mackoul Risk Solutions, who brings over 25 years of insurance industry experience. We also have Jessica Malone, Mackoul's Claims Director, Courtney Ferretti, one of Mackoul's Senior Account Managers, and Renee McFadden, Vice President of Distinguished Programs, who brings over 25 years of insurance experience with her. Distinguished Programs is the largest umbrella liability program managers in the country and has been in existence since the mid-90s. Ed, I'll let you take it from here.
Thank you, Sarah. Thank you, everyone, for attending, which is the norm these days. Please excuse any distractions, doorbells ringing, dogs barking. I got my doggy sitting right here with me. It's life is different these days, so please forgive us for any of these minor blemishes. Again, thank you for joining us. I'm going to turn it over to Courtney, really just kind of give an overview of the presentation, and then we're going to go into why you're seeing premium increases and have been seeing them for the past year or two, and how much longer you're going to see them. So, Courtney.
Thank you, Ed. Courtney Ferretti. Good morning, everyone. Today we're going to speak about the soft market versus the hard market, factors that impact the hard market, what is driving premium increases, why commercial umbrellas are out of control, what can we do to minimize rate increases, and how long will the hard market last? I'm going to turn it back to Ed.
All right. The reason let's start with the reason you're seeing premium increases is we are now in what's called a hard market. Insurance is cyclical, meaning there are hard markets and there are soft markets. A little description of both. A soft market, you're seeing lower premiums because insurance companies are really just trying to gain market share. So there's two ways insurance companies make money. They either make it through their underwriting and a profit on their underwriting and how much premiums are being submitted versus claims, or they make it on investment income. So when an insurance company is making a nice investment on the income, what they are doing is they lower premiums. So they're basically slitting each other's throat to develop business because they want to develop the market share. So you may have a $10,000 premium, another carrier may come in at $9,000, the current carrier may come down to $8,000. And so they're really trying to write as much business as they can. And they don't really care if they have to lower the premiums to do so. What happens is they're willing to offer higher limits, whether it be earthquake, flood, or different coverages. Their underwriting is a lot more lenient, so they may look the other way at claims. They may look the other way at buildings that don't have some of the requirements that they have, emergency lights, smoke detectors, etc. And there's more competition, so you'll see more insurance companies willing to provide quotes. You'll see programs that are popping up that are trying to compete with the insurance companies. So it's kind of supply and demand. When you have more carriers and programs willing to quote, the ability to get a better quote is there. Now, the hard market is the opposite. Premiums increase. So what happens is over the course of time, insurance companies, because they have charging lower premiums, they're paying more money out in claims and they're not making as much of a profit. And what happens is in times like what we're having now with interest rates and such, they're also not making money on their investment income. So what they do is they have to raise their premiums to offset the claims. And that's what's been happening in the last 2 years or so. What also happens is there are lower limits available, so they're not willing to provide as much coverage as they used to provide. So you may see, and Renee will go into this later, you may have some umbrella carriers who are putting out 25 million who may only want to put out 10 million now. They have stricter underwriting requirements, so they may still be willing to provide a quote for a building, but they are going to require certain things. They really have less tolerance at this point for buildings that have some hair on it, meaning loss history or possibly different types of electric that they don't want to work with, so that their requirements are much tighter. And there's less competition, and that's kind of one of the main reasons why insurance premiums go up. Okay, well, you may have a lot of these carriers who say, okay, well, we were willing to insure this building 2 years ago, we're not willing to do it now. So all of a sudden you have less competition, again, supply and demand. So those are really the cycles of hard markets and soft markets. So again, it's cyclical. We have a soft market, then it's followed by a hard market, and eventually a soft market comes back around. Factors that impact the hard market, as I said, insurance companies not making as much of a profit on their investment income. So nearly every insurance company uses the funds they receive from premiums to invest in other markets. However, right now, what we're seeing is reduced interest rates have a negative impact on their profitability, and carriers have basically reduced their appetite for risk as a result. So they're not willing to insure or take on as much risk. Due to years of flat or decreased premiums, eventually losses catch up and the insurance companies aren't as profitable as they'd like to be. Insurance companies basically work on a loss ratio. So for every dollar that is paid on premium, there is a certain amount that they only want to pay out towards claim. So let's say it's 40 cents. Well, for every dollar they're taking in for premium, they only want to pay out 40 cents because they may have 50 or 60 cents in other expenses. And so that's what they need to be profitable. They need to be at 40% or lower, let's say. Well, right now, when the premiums, or the last couple of years, the premiums were lower, they weren't making as much money due to claims. So now they've basically increased that so that they're offsetting their expenses. What happens in hard markets, reinsurance costs increase. Reinsurance is basically insurance for insurance companies. Okay, so let's say you have a building that is insured for $10 million. The insurance company may only want to put out $5 million worth of coverage, and then they go out and they buy $5 million worth of coverage from someone else, so that their exposure is only $5 million. Well, they have to pay for that reinsurance. In times like this, reinsurance companies raise their rates. So when the reinsurance companies raise their rates, the insurance companies have to raise their rates because they have to pay for reinsurance. So carriers often buy reinsurance for risk they can't or don't want to wish to insure fully. However, the reinsurance is becoming more expensive to obtain, which is causing the carriers to increase their rates. And what we're seeing is insurance companies start tightening their guidelines, which limits the number of carriers willing to provide a quote. So for example, you may have a building that doesn't have emergency lights. A couple of years ago, that may not have been a problem. Well, right now, the insurance companies may not want to insure a building without emergency lights. So if we had 10 carriers 3 years ago who were willing to quote, we may only have 8 who are willing to quote at this point. Some examples are buildings that don't have hardwired smoke detectors, emergency lights, and certain types of electric. What is driving the premium increase? I'm going to turn this over to our claims manager, Jessica.
Morning. So catastrophic losses are also increasing due to natural disasters. We're barely into 2021, and we've already seen about $500 million in damages from just the recent below freezing temperatures in the southern U.S. Slightly more than half of that were actually covered by insurance. In 2020, there was 57,000 wildfires throughout the world. And as you can see, 13 billion were paid out in the US alone. So the hurricanes in 2019, those insured losses were in the billions as well. 2018, Allstate said it provided gross insurance payments of over 1.2 billion for the fires in California. 2017 hurricanes Irma and Maria alone caused as much as 135 billion in insured losses.
These are only a handful of going on. So we're seeing more and more natural disasters. And although we're sitting here in New York, and you're probably saying, well, we haven't had some of this here, the insurance companies are basically worldwide. And if they aren't, or at least during the States, if they aren't, they are still purchasing, again, the reinsurance from reinsurance companies. And these reinsurance companies are the ones who are on a lot of risks. And maybe Renee, do you want to jump in and explain a little bit more about the reinsurance and why in an instance like this it would affect?
Yeah, no, absolutely. As you mentioned, Ed, insurance companies look to other insurance companies in order to help to absorb any type of future claims. And so in a time like this, we're faced with a lot of treaty restrictions when it comes to reinsurance companies. So there's treaties that are in place that specifically state, what is allowed. And you've got actuaries that are behind the scenes that are crunching numbers to predict losses. We'll talk a little bit about COVID-19 as well, but with hurricanes, I think that's a little bit unexpected as well. So when it comes to unexpected losses, it definitely affects the amount of insurance available in the marketplace, as well as the number of or the willing, insurance companies that are willing to participate in a particular segment of business, or even it could go down to a particular area. So we're talking about hurricanes. You might have some restrictions apply to states like, Florida, Hawaii. So, that would be something that we have to always consider in our industry.
Renee, we have a question here. Rather than waiting to the end, I'm just going to throw it out there. We have a question that says, aren't premiums based on region? Why does a disaster in another region impact the New York metro area?
What was that question again, Ed?
It says, aren't premiums based on region? Why does a disaster in another region impact the New York metro area?
Yeah, so, and that's a good question. That's a question that I ask at times. I'm in sales and I want to do my best to help our clients out. In this case, Mackoul is one of our key clients, our top clients. I wish that we could be able to segment that the way we evaluate the business. Unfortunately, when you have an entire book of business and you can segment that out based on, habitational, based on restaurants, if there's a catastrophic claim that's driving, um, uh, if it's driving losses in a particular region with respect to habitational, the actuaries that work for the insurance company, we're looking at the overall book of business as its own profit center. So if that particular segment or book of business is not profitable, it'll ultimately affect the premiums that are being charged or the rates that are being charged in a particular segment, and regardless of where it's located.
So basically, the insurance company is insuring, let's say it's all across the United States. So maybe their rates in the New York metro area may be higher, but they need to be profitable as a whole. So if they're not profitable in 48 of the states that they're working in, they still have to raise rates overall to become profitable. So what happens across the world, does affect what happens in New York and vice versa, because you have the same insurance companies and the same programs that are providing the insurance. So when they are taking a hit someplace else, well, they still need to be profitable. And the same thing with the reinsurance company. So although maybe, let's say we're profitable in New York, maybe the insurance company has to pay increased reinsurance costs across the world because of other disasters, which in turn flows down and raises rates here. We have another question. I think we're going to save on this one because we're going to get into it in about a minute here. So I'm just going to go on to the next slide and then we'll answer that question. What is driving premium increases continued? Court, you want to jump in on this?
Of course. Another reason is Federal Pacific stab lock circuit breakers. These breakers are considered to be dangerous and they are fire risk. So that's an issue. They're causing fires. And also it's a guideline that a lot of carriers do not want to write. They don't want, buildings that have these breakers because of the, they're dangerous. So it limits the amount of markets that we can shop your buildings to if you have them. Unfriendly labor laws resulting in 7-figure lawsuits. Social inflation. Claims are increasing in both frequency and severity year over year. One reason for this is that settlement verdicts for bodily injury claims are steadily rising. Attorneys are more inclined to take claims to trial. This extends litigation and significantly raises the cost to defend claims. Additionally, advances in healthcare have made treatment more effective and people are living longer, fuller lives even after a serious accident. While this is a positive trend, it has been an impact on compensatory damages and benefits. And lastly, instability of the commercial umbrella risk purchasing group. And Renee is going to touch base on that on the next slide.
Just want to go into the federal specific stab locks, and then maybe Renee, you can go into the labor laws a little deeper here. Stab locks, I mean, the theory with electric is, you know, older buildings, and when I was a kid, you had fuses, overfuse, and cause a fire. So the theory with a circuit breaker is when it shuts down when it can't handle too much electricity coming through. The federal specific stab locks they are known to be faulty. So basically they've been tested out, and 1 out of every 3 stab locks is defective, meaning it doesn't shut down when it should. So a lot of buildings in the tri-state area they have them. They were used between something like 1955 and 1990 or 1991. So a ton of buildings have them. So what's happened is over the last 7 or 8 years or so, the insurance companies have picked this up. And really in the last 2 or 3 days, they've kind of made a mandate that, one, they will not insure buildings that have stab locks. And if they're on buildings that have stab locks, they are looking to issue notice cancellation to get off of that. So as Courtney had said, that reduces the amount of markets that are willing to provide a quote unless you go out and replace them. Now it can be costly to do so because not only a lot of times are they the main panel downstairs, but they may be in every single apartment. So if you have a 60-unit building, and you may have to replace all 60 units and the panel downstairs, and it does get costly. On the flip side, it is really something that should be done for safety reasons. One of the big issues in New York, and the question that we had was, well, how does something out of New York affect us? Well, this is kind of specific to New York, and this affects us. But overall, it does affect the rest of the country as well, because again, if there are claims being paid out here in New York and the insurance company's unprofitable, they are going to raise rates. So Renee, you want to just give a little quick class on what the labor laws in New York and why they're so unfriendly?
Yeah. The labor laws in New York are extremely unfriendly. It's some may reference the labor law as scaffold law. And so the scaffold law in New York specifically states that if an injured construction worker, if a construction worker is injured, that worker can sue the building owner for certain types of injuries due to an unsafe work site. Also, things like gravity-related injuries, falls from heights or falling objects. New York is experiencing increased claims as a result of this. Oftentimes, what we find is that the construction workers are not carrying adequate workers' compensation coverage. And so ultimately, that's on the building owner. So we're seeing a lot of claims that result in scaffold law or labor law, and it's ultimately contributing to the hardening of the market or the increase in premiums.
Right. Now, in New York, again, it's kind of really strictly to New York. A lot of times I get a question from property manager says, hey, listen, I got a certificate of insurance from the contractor. Is that good enough? You know, Courtney, would you say that is good enough?
I'm sorry, what was that?
A lot of the times, well, you know, Renee's talking about, we're seeing a lot of 7-figure lawsuits because of injuries to contractors.
Right.
You know, what can be done to prevent that? We teach an entire class on this. It's
Right.
not long, but if you know, the question I always get is, I have a certificate of insurance from the contractor. Is that sufficient?
No, it's not. We would need a certificate of insurance. We'd want to review the contractor's policies to make sure there's no exclusions, such as a height exclusion. We'd also want to see their contract with a hold harmless agreement in it, indemnification agreement, naming the building as an additional insured. Everything has to, the certificate has to lock into the contract and make sure that the building is listed as an additional insured. A certificate of insurance would not have, that would not be enough proof for us in order to, give our okay for the contractors to move forward.
And how often would you say you get all that information on the first try?
Not often, but
Right.
we make sure to ask, we make sure to follow up with our insureds because, obviously there's a lot of risk out there, especially, in New York and the high-rise buildings, especially now that COVID is, I wouldn't say obviously over, but a lot of things are getting, things are starting to pick up again. There's a lot more work going on. There's a lot more contractors being hired right now to do facade jobs, be up on scaffolding. So we're seeing a lot of it though, especially now the weather's getting nicer. there's a lot of work starting to be done again. So we try to stay on top of it. We try to, like Ed said, educate our insureds exactly what to get. We do have checklists that we give them as well to make sure that they get all this information and for us to review.
Thank you, Courtney. So basically, long story short, we're seeing more and more claims from contractors because of the labor laws here in New York that are exceeding the $1 million limit provided by the policy. I had lunch with the president of one of the insurance companies about 2 years ago, and at that point he said they had more claims that exceeded the $1 million limit in the last 7 years than they had in the prior 40 years of the company's history. All of these labor law claims. So that is one of the reasons in New York we're seeing such premium increases. The hardening of the commercial umbrella market, and this is Renee's specialty. Renee, I mean, we've probably hit on some of this, but I'll turn it over to you.
Yeah, no, definitely. Yeah, like Ed and Ed already mentioned, social inflation, the large jury verdicts, rising litigation, and defense costs. That's the biggest factor that's driving premium up. Would be those large jury verdicts that are being awarded and then passed down to the insurance companies to pay out. So the insurance industry is experiencing a steady increase in the frequency of severe losses, as was mentioned before. Loss inflationary trends continue to exist. For example, I had looked up some data Advisen had put out September 2020, and the median payout from an insurance company for a single fatality has almost doubled in the past 5 years. So from 2.5 million to 5.1 million, which is on average a 16% year-over-year increase. So that's pretty substantial. So as an industry, we needed to take action in order to stay afloat or remain profitable so that we can continue to be a solution for business owners, real estate owners, and so large jury verdicts have resulted in insurance companies, as we mentioned, altering their appetite, which can also be dictated by their treaty placements, which would be other participating insurance companies, the reinsurance portion that we discussed. There's a more conservative approach to risk selection. Premiums have also increased across all lines of coverage, as you can see. Umbrella liability has been impacted the most. So based on data that's published by this Council of Insurance Brokers and Agents, during the second quarter of 2020, the umbrella line experienced a 20% rate increase. Individual umbrella claim settlements above $5 million represent of all umbrella loss dollars. Litigation is increasing, and so is medical costs for injured parties. Insurance companies are also decreasing capacity, as Ed mentioned before, or they're decreasing coverage limits. As he had mentioned, the traditional umbrella limit had always been 25 million, but we're seeing limits drop down to 10 million. And in some cases, insurance companies are completely exiting the market.
Right.
We talked a little bit about the COVID-19 pandemic. While we had been seeing signs of a hard market prior to 2020, the COVID-19 pandemic has accelerated the pace in which we had been going along. So I also looked into some data from the University of Pennsylvania, their School of Law. COVID-19 lawsuits began in March 2020, and they surged from April through September of last year. Insurance companies have been receiving tens and thousands of claims related to COVID-19 losses. So things like workers' compensation, that looks different these days because a lot of people are now working from home. So you've got a change in your work environment, remote workforce. What is that? What's that look like? There's business interruption. So a good example would be restaurants. They were a segment that was impacted the most by this. And so they lost a lot of income coming in. So claims were presented for loss of business income. Event cancellation. I was going to go to a wedding last year, and the wedding had to get canceled. And my friends were concerned about collecting their deposits that they had put on the venue. And then, of course, tons of people are affected by the travel insurance. Trips were already booked. And, how do you get your money back? Will you get your money back? I think the airlines were each airline was doing something a little different. Some were refunding, some were giving you credit. So, a lot of claims were presented for that. There are some signs that suggest that the COVID-19 lawsuits are beginning to level off or even decline. But we're just continue to keep an eye on that to see how everything shakes out, including, which I'm sure folks are wondering, how the insurance industry will pandemic coverage. And in a lot of instances, COVID-19 pandemic is excluded from policies, viruses, infectious disease. So that's something that the industry is really focused on. And then, as I mentioned about unexpected losses, COVID-19 related claims fall into the category of unexpected losses. And that also, again, impacts the hard market or reasons why premiums are increasing. So as you can suspect, the industries that have been hit the hardest again are restaurants, hotels, and retailers.
Interruption, play devil's advocate. So I have a 20-unit co-op on the board president of. So why does a restaurant or travel insurance affect our umbrella and the rates and the limits?
For a co-op, I was actually going to get into most challenged segments being habitational because we're now experiencing issues with labor law as well as sidewalk law in New York. So that's what's impacting the increase in premium for real estate owners.
Got it. Okay.
A lot of New York property owners, they don't realize that they're responsible for maintaining sidewalks adjacent to their properties, and neglecting to do so could lead to penalties and also lawsuits. So that's what's one of the things that's also driving the insurance premiums up. And again, we did talk about the labor law, whereas the building owners are responsible, can be sued if an injured construction worker puts forth a claim.
Understood. Now, just so everybody understands, a commercial umbrella is really just extra liability insurance that sits on top of your general liability, your directors and officers liability, and your workers' compensation policies. So no one sues for $1 million anymore. If there's a slip and fall, a trip and fall, they sue for $5 million. Their spouse is suing for loss consortium. So the umbrella provides excess coverage. And in the past, they basically are what's called risk purchasing groups. And risk purchasing groups, and Renee, correct me if I'm wrong, are basically just groups of like types of members. So most associations these days have high limit umbrellas because they were affordable in the past. All right, we can get 100 million for $3,000. It made sense to do so when it was only a couple of dollars more than 75 million. Well, as Renee had said, now there's been some changes due to losses and all these other issues. So now premiums are going up, and these insurance carriers are saying, okay, well, we don't want to give $100 million anymore. We're only going to give 15 million, and we're going to triple your premium. So we've seen some instances, and that seems to be a very big driver on why premiums are increasing on the umbrellas.
Yeah, absolutely, absolutely.
All right, what can we do to minimize rate increases? Court?
Yes. We can review all claims before submitting them. One large claim is better than 5 smaller ones. I know Jess can attest to this in the claims department where, we've had a building who reported 10 small water damage claims. None of them had payouts. They were under the deductible, and they want to know, why is that affecting their rates? Well, obviously there's an issue at the building. Why aren't you making the repairs that are needed? Why is there water damage claims every week? So that doesn't look as good as compared to one big fire that may pay out $100,000. Obviously that's not good as well, but it looks, that's more of a shock loss compared to, 5 to 10 water damage claims within the same year. So we decided with a few of our buildings, we will review all the claims before submitting them to see if, they fall under the deductible or not. You can also increase your deductibles. If you increase the property deductible from 5 to 10 or 10 to 15, there is a premium savings there. You can add life safety, such as closed circuit televisions, emergency lights, and illuminated exit signs.
Will that reduce their rates directly?
Adding this life safety, It gives you it gives us more opportunity to approach more carriers. It's more attractive if you have more life safety. A lot of carriers have guidelines. If your building is, say, over 6 stories, you must have the emergency lights or illuminated exit signs. If you don't have them, we can't approach those specific markets. So, you know, if you're with a carrier right now and you decide to install emergency lighting, it's not going to be like a credit on your policy right now. It just gives us the opportunity to approach more markets when we're marketing it at renewal. You can upgrade the electric, as we discussed before. If you have Federal Pacific stab blocks, fuses, or aluminum wiring, those are a major issue, so we would suggest to upgrade those. Same thing as a life safety. It's not an automatic credit, but it does give us more opportunity to go to more carriers for more quotes. And you can also add deductible resolutions to put more onus on the owners, and that would involve updating your bylaws. We suggest to speak to your corporate attorneys about this, but that is an option as well.
Right, and what that is basically more and more buildings are putting resolutions in their governing documents that basically say, to an extent, okay, well, if there's a fire that starts in your unit and is maintained in your unit, you would pay our deductible, because the responsibility of the association and the owners are different. So even though it may be something inside the unit, it may be the association's responsibility. And normally in most cases, the floor, if it's the original floor, the walls and the ceilings are always going to be the association's responsibility. So it may be something like a pipe under the sink that is the owner's responsibility that causes damage to the floor, which is the association's responsibility. And the association's insurance carrier has to get involved, even though it really was kind of limited to that one unit. So more and more associations are amending their governing documents to say something along those lines. If it's restricted to one unit, it's that the unit has to pay our deductible. Or if there is a claim and it happens in multiple units, well, the owners of all those units have to pay their proportionate share of the deductible. So in the long run, any smaller claims are not filed with the insurance company, because if they're under the deductible, it's hammered out between the insurance companies for the owners who pay the portion of the deductible, and really it helps out the association simply because they're not coming out of pocket for their deductible in a lot of situations. How long will the hard market last? At least I've been doing this 26 years. You know, it's hard to give a definitive answer, but typically the hard markets last a lot less than the soft markets. So hard markets typically last 2 to 3 years. That may be different now, as Renee had said earlier. COVID is kind of a factor we have not had to face. So typically a hard market may last 2 to 3 years, and the soft market may last 5 to 6 years. In this case, I would say, at least for habitational buildings that residents live in, it's already been 2 years, and I don't think that's going to change over the next couple of months or so. So at the very least, maybe 2022 changes, but for the foreseeable, the rest of 2021, I'm going to say we're going to continue to see premium increases and the same issues we're seeing now. And if COVID, which is the next bullet here, if COVID happens to really rear its head to an extent on the insurance side, as Renee had said, we're kind of the claims are starting to abate a little bit at this point. But we've seen in the UK where the courts have ruled that the insurance companies were responsible for some of these claims, the loss of income claims. If that happens here and the insurance companies start paying out a lot of money towards the loss of income, that is certainly going to extend the hard market, because as Renee had explained earlier, this is something that really wasn't foreseeable. So there really wasn't anything. You have these actuaries who can really document the number of fires that are averaged, how much damage is caused. Well, they can't do that here, and they couldn't do it, so there really wasn't a charge for it. So if they have to go out and pay a lot towards a lot of these loss of income claims, rates are going to go up, because eventually they do have to recoup that money. And the umbrella, Renee, what do you foresee with the umbrella over the next couple of years, or do we see any changes going back to the way it was 5 years ago? What would you say?
Yeah, I agree, Ed. I've been in the business for, about 25 plus years. Same, hard markets typically I've seen last 2 to 3 years. I think this is different. I think this is really different. And I don't foresee that the umbrella market will go back to where it was. I do think that there will be some relief in the future, but I don't see it going back to what it was. When I entered the business, you probably could get a $100 million umbrella for $1,000, $2,000. So, that's just been steadily creeping up. Even if you look back to maybe 2015, things had changed substantially. But given what's going on with, as you mentioned, COVID is just the first time in my lifetime that I've experienced anything like this, and I'm sure a lot of people. I don't foresee it going back to what it used to be, but I do see some relief in a couple of years once we can kind of get our arms around what's out here, what's the emerging risk look like, what are some of the exposures that we had not dealt with in the past that we now need to deal with, and we'll collect enough data so that our actuaries can make some informed decisions about the path forward.
I agree with you. In the 26 years we've been doing this, this is by far the worst hard market that I've seen. So I don't think it's the same as all the other ones. And we can only hope things change by next year. But like you said, it could be a few more years. All right, let's go to the questions that we have here. If my building has several claims on record, but they haven't been paid on, will that have any impact on our renewal/premiums, Jess?
It most certainly can. As Courtney touched on before, if your loss runs just look like 10 of the same types of claims, the carrier's going to look at it as, well, eventually one of these is going to exceed the deductible and it might be a large payout. That being said, we really won't know until the renewal time comes. I get asked that a lot. How will this loss affect my renewal or my premiums? We can't really speak too hard on that, but yeah, frequency is a big factor.
And frequency is a bigger factor in hard markets than it is in soft markets. So in hard markets like we are now, they really look at everything. And that's what we're saying. They're a lot more stricter in hard markets and a lot less stricter in soft markets. So if we were in the midst of a soft market, the answer would be different. It may be like, okay, it won't be an issue where it is an issue now. And what both Courtney and Jessica have said is these smaller claims are more of an issue than the larger claims, simply because they look at it as a maintenance issue. So if we keep having slip and falls outside and nothing has been paid on, could that affect the renewal premiums? The answer is yes, because they may say, okay, well, nothing's happened with these slip and falls, but we have an issue here. Maybe the sidewalk's not level, or maybe the super isn't getting out there and salting when there's snow and there's ice. And they say, okay, well, nothing's been paid out, but eventually something is going to, and they could raise the premiums. The same thing with the plumbing. They may say, okay, we've had 5 plumbing claims in the last couple of years and nothing has really been paid out, but eventually we're going to have a large one because we have issues with the plumbing. So the answer really all depends on the type of market we're in, but for the most part, the insurance company will review it, and it certainly could affect the renewal premiums. What has been the average rate increase for commercial package policies over the last year? Courtney, what would you say?
I mean, I would say at least 10% we're seeing across the board. I mean, there are some carriers that are a little bit lower than that. Then there are some that are higher. Obviously, the claims are an issue. If you have a lot of claims, it's going to go up higher. But it really depends on the carrier. But I think I could say, I mean, Ed, you can correct me if I'm wrong. I'm thinking 10% is probably a good average to say.
Right. We had told our insureds for the last year and a half or so to budget for 10%. Like Courtney had said, good buildings, and good buildings may just simply mean buildings that don't have claims on record or any hair on record may only see 5 to 7%, whereas buildings that do have claims or Renee had mentioned label law claims, an open label law claim or even a closed label law claim, it scares the insurance company. You may see a 10 or a 15 or a 50% rate increase. We've had ones that have significant increases because they have an open label law claim that's reserved at $500,000 or $1 million, and their rates are increasing astronomically. So I would say you budget 10% and hope for the best at that point, but at least you're prepared. Because if you're budgeting for a flat renewal, even for 2022, I think you're going to be in for a surprise. If we do upgrades to our building, will we receive premium credits from the carriers? I think we went into that a little earlier. Courtney, so if they add smoke detectors, the emergency lights, he had mentioned, it is not a direct credit. So it's not like they're going to say, hey, we're going to reduce premiums by 10%. What it does is it makes you more attractive to not only that carrier, but any other carrier. So when it is time to remarket, that allows us to go to a company. Let's say if you've added emergency lights, there are carriers that require emergency lights. If you don't have them, we can't go to them. They will not provide a quote. So this allows us to access more markets, which in the long run will provide the ability to lower your premium if we can get additional quotes.
Yeah, and Ed, to that point, it's, I believe you guys mentioned it already. It's important to keep detailed records about these things, about updates that are made to your properties, about a preventative maintenance plan, and maybe keeping a log of that, dates and things that have been done to help in the proactive efforts of maintaining property. And that's the information that the insurance companies love to see. In a hard market, especially, it's about, a presentation, for lack of a better word, providing all of the great things that your building or your company is doing to help mitigate claims.
Right. Thank you. Another question: when did this hard market start? My premiums have increased 30% in each of the last 2 renewals. That is probably from, at least internally, and I'll ask Renee the same question. We've seen it started basically in 2019. So we're in probably year 2 or 2 full years now at this point. Renee, now your umbrella insures a lot more than habitational, which is our niche. So would you say 2 years more? What have you seen?
Yeah, I would say that we have been seeing for more than 2 years. We insure habitational restaurants, hotels, but I would say most of the change has been on the habitational side.
Right. And different other markets like contractors and such may have seen, they may have seen it 3 years ago, or they may continue to see it a little longer. So each industry is affected differently, but from the co-op and condo marketplace, we've seen it since 2019.
Yeah.
Will the HO6 policies help offset the increase in responsibility of the unit owners? An HO6 policy is basically a condominium unit owner's policy, and it covers an owner what they are responsible for in the unit itself. And that really doesn't affect what the association is responsible for. So from a perspective of will that help offset the increases? The answer is probably not. Again, the increases are due not just to specific loss history or buildings themselves. And yes, the worse loss history you have, the worse your increase may be, but the industry is seeing an increase on an overall basis. So an HO6 policy really just provides the owner with what their responsibility is. It doesn't really take off any of the responsibility from the association. What you can do, again, is amend the governing documents to put different responsibility on the owners themselves, in which case their homeowner's policy would be responsible. So let's say right now, a lot of properties will have that the association is responsible for the original condition of the unit, with the owners who's being responsible for the improvements, betterments, and some fixtures. Well, if you were to change that to say that the owner is responsible for everything they can see, feel, and touch, that would increase the owner's responsibility, decrease the responsibility of the association, which would result in less claims and less claim payouts over the course of time. So if you change the governing documents, that could change. But just by everyone having insurance, I don't think that would really change the increases that we're seeing. If we do upgrades to the building, we'll receive premium credits from the carriers. As indicated, the answer is not a direct credit. You become more attractive, and that opens up the ability to have more markets provide quotes, which could lower your premiums in the long run. So the answer is there won't be premium credits, but you will experience probably a lower premium in the long run, simply because the main top carriers, they want to make sure you have certain things in effect that will protect yourself as well as the people in the building. And so if you don't have these upgrades, they may not be willing to provide coverage for you, which will in the long term increase your rates. During a soft market, is there a plan we should have in place to prepare for when a hard market hits? Courtney, Renee, what do you think? Jess?
Yeah, the statement that comes to mind is stay ready so you don't have to get ready. So yeah, so I would say the same things you're doing in the hard market, I would say continue to do in the soft, so that way if if the hard market hits in the future, you're not scrambling. So stay ready so you don't have to get ready.
Right, I agree. I think you do the
Yeah, I
same thing during the soft markets, the hard market. Review your claims. Think about whether you want to submit a claim. If it's a fire and you've had $8,000 worth of damage or $10,000 worth of damage, you have a $10,000 deductible. Does it make sense to submit it? Does it make sense to submit it if it's $11,000 in damage and a $10,000 deductible? For $1,000, probably not. So take a look at your claims. Add your life safety. I mean, that isn't going to change. So emergency lights, upgrade your electric, keep your eye on plumbing. There are companies out there now who are starting to do sensors to avoid water damage issues. You may want to look into these. So the more you do now, the more attractive you are, whatever type of market. Of the 7-figure lawsuits, what is the average payout in reality? Renee, you threw out a couple of figures earlier. You want to just kind of maybe expand it? Maybe that doesn't answer the question. I don't know what it is. I can tell you some of the ones we've seen. We saw one where a building they had a water damage claim, which was repaired, and the insurance company came in and said, we want you to scrape and paint the stairwell. And it was just the stairwell leading up to the roof. They hired, I don't know if it was a guy in the building or his nephew, $625 to scrape and paint the stairwell. He came in, he couldn't reach part of the area, so he put a paint can down. He still couldn't reach it. He put a second paint can on top of the first paint can, stood on that, and eventually he fell and he was injured. He was critically injured. He had some major issues, short-term memory loss. I mean, he really had some issues there. And the insurance company paid out $4.2 million for a $625 job. So I can't give an exact what the average payout is in reality. But the insurance companies see enough of these 7-figure lawsuits over the last 7 or 8 years that it's changed the way they're thinking.
Yeah, I can't say that I have real examples to present at this time, but yeah, the payouts are steadily increasing. An injury cost in 2015, may have close to doubled in 2020 and also 2021. So another factor is society is more aware of the laws. The information is at our fingertips with the technology that we utilize on a day-to-day basis. So, we have fraud claims that come into play as a result, or if it could be a legitimate claim, but if there's precedence that says a jury awarded an injured party $5 million last week for something similar that someone else might be experiencing, that's when the light bulb tends to go off, and that's kind of contributing to why the jury payouts are so high and ultimately affecting the insurance premiums.
Right. Agreed. Remember, the HO6 policy will be required by your lender if you are purchasing or refinancing your unit. That is correct only in certain instances. If you're a condo building, the mortgage company requires you to have homeowners insurance. If you are paying cash, you will not have a lender, you're not required to have insurance. And the truth is, some people forget. And I always tell a story. My father, many years ago, who started the agency, he bought a condo in the city and showed up to closing and forgot to have insurance, and he had to actually get it done that day. So if he could forget, anyone could forget. Also, in co-ops, the shareholders typically not required to maintain insurance. When they show up at a closing, they have to show up with a certificate of insurance, the proof that the association has coverage. So there are plenty of instances in the co-op where a shareholder may not have an HO6 policy. And the HO6 policy, even though it's named condominium unit owners policy, it provides to unit owners in a condo as well as shareholders in a co-op. What about business interruption insurance, loss of rent from commercial space? Yeah, I'm not sure what the question is, that loss of rent from, okay. So business interruption basically covers you for the income you cannot collect due to a covered cause of loss. So it has to be a covered cause of loss. So if you have a fire in a commercial space and they are choosing not to pay their rent, that is something that would be covered because fire is a covered cause of loss. If we're talking about COVID related, that's where we've seen a lot of these instances where commercial spaces, due to the fact that they could not open, or they could not, especially restaurants where they couldn't have people dining in, or they can only do delivery. So either they were closed and they weren't making as much money, or any money for that matter, or their sales were way down. In the instance of COVID, and this is kind of what's going on in the industry, the insurance companies basically, for the most part, have denied these claims, indicating that COVID is not a covered cause of loss, and that damage, in order for the loss of rent to kick in, it's got to be, one, a covered cause of loss, but there also has to be physical damage. And it's been deemed that this has not been considered physical damage. And the question comes back into play, is this coverage under the business income called civil authority, which basically says if there is something in a certain amount of distance from where you are and the government requires that area to be shut down and people can't access your business, there's coverage under business income. But again, there needs to be physical damage resulting, and the theory, and the insurance companies have been denying it, is because there is no actual physical damage. COVID, they say, can be cleaned up. You can have it cleaned up 1, 2, 3, basically, with proper cleaning supplies, etc. And so there is no physical damage. So yes, there is loss of rent coverage in commercial space, but again, it has to be due to a covered cause of loss, such as a fire or a hurricane or something to that extent.
Yeah, and Ed, it's interesting. As you were talking, I thought about an article I read a couple of days ago. The article stated, as a result of the pandemic, there were a lot of building owners that were accepting decreased rent payouts or payments from their tenants. And it warned building owners to be careful about doing that, because if you have an agreement with a tenant to say just, pay $2,000 a month rent, but because of the pandemic, they can only pay $1,500, and the building owner accepted the $1,500, potentially, depending on, the laws, the building owner and the tenant could be entering into a new agreement based on $1,500 a month versus the $2,000 a month. So I just wanted to mention that for building owners to just think about that, and how that also could affect the amount of business income payout they would receive from the insurance company if it were to, evolve into that.
Good point. Most co-ops are requiring shareholders to have their own insurance. That is, I see more and more requiring it, and I think it's a great thing. I think it's a great thing for the shareholders, the board, the property manager, because it will dispel some of the arguments that happen there. It also, certain things, a lot of the times the board sometimes will make what we call charity decisions. Someone doesn't have insurance, there's fire in a unit, they can't live there, and the board helps them out by paying, the cost of them to live elsewhere, and that should not be done. An HO6 policy covers the owner for what they're, one, responsible for in a unit, two, their contents, three, income, or excuse me, I should say additional living expenses. If they can't live in their unit, they have to live in a hotel, they can't cook because they don't have a kitchen, they have to eat out. Their policies will pay for that, whereas the co-op or condo sometimes made that decision to help that person do so, which in the long run is actually the wrong decision, because if you don't do it for Courtney, but you did it for Jessica, then you have an issue on your hand there. So I do hope at some point that all co-ops require their shareholders to have insurance. The problem with that is unless when it's converted, unless it's in the governing documents at that point, it has to be changed. And in order to change it, you need 2/3 of all the shareholders to agree upon it. And that is generally not very easy to do. Okay, and the question they expanded on COVID about the business income, I think we basically answered that. So COVID right now has been considered not a covered claim. Could that change? We've seen in the UK sometimes the courts have, but with the co-op and condo policies, they're pretty much cut and dry. Whereas, so the wording in there has been somewhat specific, saying that it is not covered. A lot of these places in the UK, which the courts have deemed that the business income is covered, these are basically manuscript policies, which are policies that they kind of put together piece by piece, and there was certain wording that was excluded in there that is not excluded in the policy that most of the co-ops and condos have at this point. And the last question at this point, is there any minimum insurance policy requirements for co-op shareholders? We, as an agency, when we provide we provide documentation for boards to distribute to their shareholders, we give minimum limits. there is nothing specific in there in that is required by a lender. So we provide saying what we think the minimum is. Now that's not what you should have. You may need more, but on a minimum basis, we'll say something like, okay, you should have at least $25,000 worth of improvements or betterments coverage. Now that may not be enough if you've gutted out your entire kitchen and done 2 bathrooms, but on a minimum, at least you have sub coverage there. So there are no real minimum insurance policy requirements. As one of the questions that said more co-ops requiring shareholders to have their own insurance. What should be done inside the governing documents is if we are changing the bylaws to indicate that shareholders are required to have insurance, there should be some requirements for the coverages they should have, as well as the limits they should have. And if anybody wants to reach out to me, we do provide a memo that you can distribute to your owners that indicates the types of coverage that should be maintained, as well as suggested minimum limits. Was there any coverage payouts for the damage caused by the rioting last year? And if so, was it significant enough to affect the increases across the board? Renee, have you seen?
So I haven't seen any paid out, but I have seen a handful appear on loss documentation. So I've seen it on loss experience or loss runs where the claims are open. They've been submitted to the insurance company. That's the extent of that. I haven't seen any closed and paid. I think because it's still so new, the pandemic, the COVID-19 virus, companies are still trying to get their arms around it. Claims departments are reviewing policy language in detail to determine if there is coverage available. I'm sure in the meantime, if lawsuits ensue, there'll be some defense costs that are included or in need of being paid out on that front. But I haven't seen anything paid out in terms of indemnification.
Okay. In our agency, we saw a few payouts. They weren't significant, and so from an overall basis, in the industry, I don't think it will affect. From an individual basis, so for an individual co-op or a condo, could it affect? The answer is yes, simply because it's another claim on record. So, and they all understand that it's probably not going to be the norm, and it's not a maintenance issue. It is still a claim, and an insurance company is in business to make money, and if they're not profitable, they can and will increase premiums. So, again, it was the amount that we saw were minor. And I don't think on an overall basis that it should affect insurance premiums too much. Okay, looks like that is it. I want to thank everyone for attending. If you have any questions, our contact info is here. As Sarah had mentioned earlier, a copy of the presentation will be emailed to you. If you do have any questions that you think of afterwards, please do me a favor, send me or any of us, send us an email and we'll let you know. If you want any of the information regarding the homeowners, what the coverages are required, which coverages they should have and suggested minimum limits, please reach out to me. But again, thank you, everyone.